Assalamualaikum and a very good day to everyone. So today we're gonna go into chapter 4, which is a principle of double entry and trial balance. So this is the chapter's outline, starting with the double entry system. Next you'll be learning the ledger's entry. After that is balancing of ledger's account. Lastly being able to make a trial balance. So before we start with this chapter, I would like to refresh some of your memories. Just as I stated in chapter 3, this is the basic in accounting equation, which is asset equals to owner's equity plus liability. So this is the basic of any records in accounting. So before expanding, this is the three account. The first and basic equation. So as you know, owner's equity has 4 accounts under it. The first one being capital. The second one being revenue. The third one being drawing. Lastly is expenses. So if you expand the equation by putting all these 4 account in the equation, so you will get asset equals to capital plus revenue plus, since revenue increase owner's equity, minus expense because expense reduce owner's equity, and minus drawing as drawing also reduce owner's equity. Lastly, just bring back liability plus. So if you rephrase or restructure back this equation, you will get asset plus drawing. If you just like simple mathematics, bringing the right side negative drawing to the left side, you will get a positive drawing plus expense. Since expense is also negative on the right side, so you just bring it to the left side, equals to capital, which is already positive here, plus revenue, also already positive on the right side, and plus liability. Just bring it down. So you will get a simplified equation being ADE equals to CLR. You can try to memorize it as other, ADE other, CLR being color, or any other words that you can think of. Since color, the only different alphabet being C, LR, and the middle one will be O only. So you could remember it as that, write that. Okay, so this is the basic. Try to remember it. Okay, next. Okay, so January 10 receive cash commission of 2,000. Okay, so you're receiving cash commission. Okay, you understand that this is a revenue, okay, or income. Okay, how do you record this? What are the effects? Okay, so when you receive a transaction like this, the first thing you have to know is that what form does the income came in. So we can see this, it came in a cash form. So our asset increase, okay, asset increase in cash form, cash. So next is the revenue also increased. Okay, so the revenue also increased. Now let's us record it in the double entry rule. So which side does the asset increase? Asset increase in the debit side, and cash is the asset. So what is the revenue? Revenue increase in the right side, which is the credit. So you record credit as commission income. Okay, so this is what you record in the double entry. Now we open our ledger, first being commission income, second is our cash. So a tips for you all, since usually payment or receipt are made by cash or through banks, so you have to look back in the past transaction whether the cash account, this one, and bank account have previous transaction. Just like before, we can see that the bank have a few transaction with it. Let us look whether the cash have past transaction. So it seems there was no cash account open. So if there's no cash account open, you can just proceed with putting Jan 10 of Jan, commission income 2000. Okay, oh sorry, in this they have 2000 also here. So for the commission income, since it increased in the credit side, so you will have to put cash in here. Right, okay, cash 2k 10 of 1. Okay, see, so when people look at your ledger account, they can see that in cash income you receive cash for the commission about 2k, and in the cash it increased due to commission income about 2k. Okay, understand? Let's look for the next. This is our last example, drawing. Okay, 15 Jan, owner took cash of 200 from business for self-use. Okay, so when they say self-use, meaning it's not for the business, the owner took it for his own use. So it's a drawing, deduction in business. So you have to record this in drawing. So you can see that took cash. So asset decrease in cash form, but drawing increase. So owner's equity increase in drawing. Okay. So when the drawing increase in the debit side, other, remember? ADE, the D is on the left side. So drawing or withdrawal. You can also write that one. We have credit, cash, since asset is reduced. Okay, about 200. So let's us open the T account. We will have cash. We will have cash and also drawing. So previously, cash have a transaction of Jan 10 around here for income, about 2K. So we record on the credit side on 15 Jan a reduction in drawing for 200. Okay. So next is drawing. So drawing, you can record it on the debit side, 15 Jan, cash of 200. So you can say that in the drawing account, cash is taken about 200. Okay, understand? Okay, let's proceed. Okay, so we're gonna go into the duality concept. Duality concept is each transaction has two sides or dual effect of each parties involving in its double entry known as debit and credit. So debit literally means just left side, and credit is just right side. This is just the literal meaning. So you just remember, when it's debit, it's a left. When you think of credit, it's a right side. Okay, just like before. So this you can already have you can already see the left side and the right side here, and we have a middle ground which is the equal here. So this is the debit and this is the credit. Okay, when you are on the debit side, which means on the left side, you will the debit shows an increase. See, so when you're on the debit side, you increase on the left side. So any equation that you put ADE on the left side will cause them to increase. Whereas for the right side, which is the credit side, you have the color CLR, they increase on the credit side. On the credit side meaning the right side. So if the CLR is put on the right, aka credit side, they will increase. So this is vice versa. If they're put on the debit side, they will decrease. Just like the debit side, if they put on the credit side, they will also decrease. So you don't have to remember both of it. Just try to remember what the part that brings them the increase. Okay, so when they increase on the debit side, of course, when put in the credit side, it will be decrease. Okay, so kamu ingat macam tu je. Kalau ADE ada terletak bahagian kredit, of course lah dia decrease sebab dia increase sebelah debit. Okay, so next. Okay, so we'll go into this example. January 5. Faris buy RM200 goods by cash. So you can see this, there's a transaction here. So the effect will be decrease in asset, which is cash, since you pay for buying the goods, and increase in expenses, since the account is purchased. So first, when you're given such a transaction, you need to know which account increase and which account decrease. The effect in here, the effect. So first, know the effect. So when buying goods or stock, you will have a decrease in asset, since you will have to pay for the things that you buy. So what will be increasing? It will be increase expense. Okay. Why expense? Because the things that you are buying is goods or stock or inventory, things that you use for the business operation. So it's an expenses. Okay. Okay. After you've noticed which account is decreasing, which account is increasing, next you have to identify what is increasing and what is decreasing. You can't record it as asset. You have to record it as the terms that is being used. So asset in this transaction is cash. So your cash is reducing. So what's increasing? Your expenses. So the terms that represent expense in this transaction is purchased. So this is the things, the terms that we'll use to record the double entry. So lastly, you will have, so when cash decrease, when asset decrease, it is on the credit side. So you credit cash. And when purchase increase on the debit side. So you record it like this. So purchase. You can see that you record the debit side more to the right, while record the cash side more to the left. More to the right. I'm sorry. So you record the debit side more to the left, while you record the credit side more to the right. Just like I was stated before. So what is the amount? 200. Okay. So it has to be balanced. You have to have one on the debit side and one account on the credit side, the amount being the same. Okay. Okay, so now we're going to make an account. Okay, an account is an individual accounting records of increase and decrease in specific account, being asset, drawing, expenses, capital, liability, and revenue. So this is the specific account. So after you identify the transaction, you will transfer it into a T account or a ledger account. So in that ledger account, it will consist of the title of the account, the left side or right which is the debit side, or right side which is the credit side, as I explained before. And after that, it's an act of entering an amount on the left side of account. It's called debiting, and making entry on the right side is called crediting. So T account, the account will look like a T, like this. So you will have a title. After that, you will have a debit side, which is this one, and credit side, which being like this. So after you've made the transaction, you will put the transaction in this account, a T account or a ledger account. Okay, so we go into the next slide. Okay, see, this is a T account. In the T account, you will first have a title. You will also have a left and right side, left being the debit and the right being credit side. You will have a date. Particular is the name of the item. For example, if you use the example before, you put cash here, amount being 200, and the date being 5 January. Okay, so you put the name of the account that you record in the journal, in the double entry. So left side being debit, right side being credit. Double entry means that every transaction is recorded twice. Thus, in accounting, all transactions have dual effect. One on the debit side of the ledger and one on the credit side of the ledger account also. Okay, as I said before, in accounting, everything has to be balanced. Okay, so next. Okay, rules to identify whether the transfer should be debit or credit. So this is just the same as before. You can see that other ADE increase on the debit side and they decrease on the credit side. For the color CLR, increase on the credit side and reduce on the debit side. It's just the same. Whether in journal or ledger, they will have the same effect. The left side will increase. The left side which is the debit will increase on the debit side and decrease on the credit side, whereas for the color, the right side, the item on the right side will increase on the credit side and decrease on the debit side. So you have to remember, okay? Where at least remember which part they increase, that will be able to simplify your calculation later on. Okay, so to analyze of transaction, these are the this is the suggested steps. You can also have your own step if you understand more. So this is only suggestion. First, you have to determine the impact of the transaction on two items. So as I stated before, two impacts, whether increase, which account increase, which account decrease. So determine whether the account is an asset, liability or owner's equity, which are the capital, revenue, expense, and drawing. So after identifying the increase and decrease, you have to identify the account. So after you identify which account, so you have to know for each item affected by the transaction whether the account increase or decrease. So after you identify the increase and decrease and the account that is involved in the transaction, you have to know which account increase or which account is decreased, and later on determine whether it is recorded in the debit side or credit side. Okay, so now we're going to go into an example. This example is for asset. So Jan 1 bought computer worth Rm 2,500 by check. So the transaction is buying a computer and just a moment. Okay, buying computer. So by check. First is what's the effect of the transaction. So you can see what account is affected. A computer is a non-current asset. So does it increase or decrease? So buying increase the asset since you're adding new things to it, worth 2,500 by check. So you pay it by check. Thus another asset is decreasing. But what is the asset? Check is bank. Okay. So when you pay by check, the account will be bank. So you can see that this is the transaction. So what are the double entry rules? So when an asset increased, it's on the left side, which is the debit. So when you buy a non-current asset, you must record it with its name. So you're buying a computer. So when you're paying the asset, it reduced another asset. So when asset is reduced, it is on the right side, which is the credit side. And you put bank. You can't put check, okay? Put bank, since the check is money in your bank. So this is the ledger entry. Okay, you got a debit and you got a credit, both amounting 2,500. So ledger account. So let's make a ledger account or a T account. So as you can see, there are two accounts involved. When two accounts is involved, you have to open two T accounts. Okay, since they're separated. So there will be two different T accounts. The title, you have to put computer. And bank. Okay, so this is the title, the item, okay, the account's name. So when you're trying to record the computer is on the debit side. So debit is on the left side, credit on the right side. So when you record the computer, you can't put the computer in here. It's already an account for computer. So you put bank. Okay, put bank. The opposite account in the journal. Okay. So you put bank amounting to 1,500 on the date 1 Jan. Okay. But when you put this name, you still have to put it on the debit side because the computer is on the debit side. You just record it as bank because it is paid by bank. So in the bank ledger, you must record what is reducing it. So you can see that computer is here, amounting 1,500. Okay, you can see this is how you record a ledger. You have to record the details in with the opposite transaction name, so you know in the account what is what's caused it to reduce, what caused it to increase. Okay. Okay, next. Okay, so this is an example for liability. Jan 3 bought office equipment worth 1,000 on credit from Jati Perabot. So on credit meaning has not been paid. Okay, credit. Has not been paid yet. Been paid yet. Okay. So the transaction exists, but it has not been paid. Okay, so when it is not being paid, you have to put under account payable. Okay. Account payable, you have to pay. Okay, so this is your liability. So for account payable, there are two types. So the first one being non-trade payable. The second one being trade payable. So trade payable is for suppliers, meaning buying stock for the business operation, while non-trade payable is buying from non-suppliers. So you have to write its name. Okay, not buying stock. Non-trade payable is not buying stock. Okay, not stock. This is stock. So you can see from here, they bought an office equipment from Jati Perabot. So this is not a stock. Okay, so you have to write the name. This is not the business stock. So the first effect of the transaction, So the effect of the transaction is increased in non-current assets, since you're buying an office equipment, and you also increase your liability since you bought it by credit. See, bought by credit. So after you have determined the effect, you will go into the double entry rules. Okay, so you increase non-current asset. So non-current asset increase on the debit side. So what is the non-current asset? Office equipment. So it is an office equipment. So when the liability increase on the credit side. Okay. So what is the liability? Jati perabot. Account payable jati perabot. Okay. So you already got the double entry with the amount of 1,000 each. Okay. So what are the ledger account? So just like I said, this involves two accounts. So you have to make two T account. This is the office equipment, and this is the account payable for Jati. So when you record for the T account, you have to put in the different account, the contra of the record in the double entry. So office equipment is in debit, so you have here, so it's 3 Jan. What is the contra account? Jati perabot, amounting to 1,000. So you can see office equipment, which is an asset, increase from buying from Jati perabot here. Okay, buying from Jati perabot. So for Jati perabot's account, 3 Jan, you record as office equipment amounting to 1,000. So you know that you owe Jati perabot for buying office equipment. See, you can see that. This is why you record the contradict account. Okay. So next. Okay, so now we go into the owner's equities account, starting with capital. So Jan 4, the owner deposit 10,000 into the business bank account. Okay, so the owner, you can see that the resource of the money comes from the owner. So when the owner deposit or give asset to the company, it is a capital. Okay. Okay, so where did he put the money? In the bank account. So what are the effects? So the effects are when the money is put in the bank account, what will increase? Bank, right? So bank is an asset. So the asset increase. So when the owner deposit 10,000, what also increase? Owner's equity, right? So owner's equity increase. OE for capital. Okay, so what are the double entry rules? So when asset increase, it is on the debit side. And you debit the bank since bank increase. So when owner's equity increase, which is the capital, where does the capital increase? Capital increase on the credit side. Remember color. C is on the right side. So put here. So your credit will be capital. So what are the amount? 10,000 each. Okay. So you can see they are balanced. So these are your journal entries. So now let's make the journal itself. Okay. So you have two ledger. You have to make a ledger. These are your ledger entries. Let's make a ledger account. So there are two accounts involved. First being bank. And second being capital. So bank already have a transaction. Remember on the previous slide. See, you can see that bank already have on its credit side a 1 Gen computer for 2,500. So when you compile with the next transaction, bank already exists 1. So 1 computer 2,500. So we already have that. Capital is just a new account. So when you see this transaction, the bank is on the debit side. It's 4 Gen. 4 Gen, what is the explanation? Capital what is the amount? 10,000. Okay. So what is the capital account? So capital is on the credit side. So when it's on the credit side, you put it on the credit 4 Gen. Okay, what is the name? Bank. Okay. So the owner put the capital in the bank amounting 10,000. Simple, right? Okay, so next. Okay, so this is an example for another owner's equity, which is expenses. Okay, Gen 6. Paid rent amounting 500 by check. So check again. This time paid for the rent. Okay, so you can see that it already paid the rent. So the account that involved is expense increased and check, which is asset. So asset decrease. So when you pay by check, it is bank. Since check is money in bank. So what are the double entry? First we start with the debit. Which account is on the debit side? The expense. Okay, so since expense increase on the debit side, other, remember, ADE, the E one is on the left side. So you don't just write expense, you need to write what expense? We need to know, so it's the rent expense. Okay, so what are on the credit side? Bank, since it is paid by check, both amounting to 500. Oh, sorry, 500. Okay, so these are your entries. Let's make a T account. So we have two account again, which is the rent expense and the bank. As you know, bank already have a previous transaction. 1.1 being computer, and I think it was 4. Yeah, 4 Jan being the capital. Okay, so this is amounting 10k, which is 10,000. The computer is just 2.5k. Okay, 2,500. So now you put on the credit side another new transaction, 6 Jan, which is rent expense. So you can see that the money in the bank keep reducing on the credit side. Okay, the bank itself have many transactions. So you have to put the transaction of the 6th January on the credit side being rent expense amounting to 500. Okay, so what do we put in the rent expense? Rent is on the debit side, so you put 6 Jan bank. So you can see that for the rent expense, it is paid by bank amounting to 500. Okay, so let's go to the next example. Okay, so the next example is another owner's equities account, which is an income or revenue. Okay, so January 10 receive cash commission of 2,000. Okay, so you're receiving cash commission. Okay, you understand that this is a revenue, okay, or income. Okay, how do you record this? What are the effects? Okay, so when you receive a transaction like this, the first thing you have to know is that what form does the income came in. So we can see this, it came in a cash form. So our asset increase. Okay, asset increase in cash form, cash. So next is the revenue also increased. Okay, so the revenue also increased. Now let's us record it in the double entry rule. So which side does the asset increase? Asset increase in the debit side, and cash is the asset. So what is the revenue? Revenue increase in the right side, which is the credit. So you record credit as commission. income. Okay, so this is what you record in the double entry. Now we open our ledger, first being commission income, second is our cash. So a tips for you all, since usually payment or receipt are made by cash or through banks, so you have to look back in the past transaction whether the cash account, this one, and bank account have previous transaction. Just like before, you can see that the bank have a few transaction with it. Let us look whether the cash have past transaction. So it seems there was no cash account open. So if there's no cash account open, you can just proceed with putting Jan 10 of Jan commission income 2000. Okay, oh sorry, in this they have 2000 also here. So for the commission income, since it increased in the credit side, so you will have to put cash in here. Right, okay, cash 2k 10 of 1. Okay, see, so when people look at your ledger account, they can see that in cash income you receive cash for the commission about 2k, and in the cash it increased due to commission income about 2k. Okay, understand? Let's look for the next. This is our last example, drawing. Okay, 15 Jan, owner took cash of 200 from business for self-use. Okay, so when they say self-use, meaning it's not for the business, the owner took it for his own use. So it's a drawing, deduction in business. So you have to record this in drawing. So you can see that took cash. So asset decrease in cash form, but drawing increase. So owner's equity increase in drawing. Okay. So when the drawing increase in the debit side, other, remember? ADE, the D is on the left side. So drawing or withdrawal, you can also write that one. You have credit, cash, since asset is reduced. Okay, about 200. So let's us open the T account. We will have cash. We will have cash and also drawing. So previously, cash have a transaction of Jan 10 around here for income, about 2k. So we record on the credit side on 15 Jan a reduction in drawing for 200. Okay, so next is drawing. So drawing, you can record is On the debit side, 15 Jan, cash of 200. So you can say that in the drawing account, cash is taken about 200. Okay, understand? Okay, let's proceed. Okay, so in this slide, we are going to focus on inventory, okay, or stock. So it is important for you to understand this this subtopic because inventory is a big part of a business. It's an important asset in a business operation since they are their main expense and their main income for the business. Okay, so for inventory, they have 4 types of transaction. The first one being purchase of inventory. The second one being sales return or return inward. The third one being sales and the fourth one being purchase return or return outward. Okay, so you can see from the description it says increase in inventory is due to purchase of goods and sales return or sales inward. So you can say that both of these transactions cause an increase in inventory, while both of these transactions cause a decrease in inventory. Okay. Okay, so these 4 are the main transaction in the inventory. So I'm going to show you how this transaction is recorded in a financial statement. Okay, so as I said in chapter 3, for revenue and expenses, they are recorded in the profit or loss, right? Okay, so these are the profit or loss statement. Statement of profit or loss for the year. You can look it up in page 88. Okay, it is the same statement in your book. So okay, so as you can see, the sales is recorded. The first one, sales is revenue. So you gain revenue through sales of a business, and it deducts sales return or return inward, which is a return made by customers to us, the business. You see, it comes back in to our business. Does this reduce our sales? That's why it says less here. See, less, because it reduces our sales. So after the sales income is total up here, we're going to deduct the cost of sales, which is we have inventory. The opening inventory is the inventory from last year, the balance of last year, and purchase. Okay, so this is an expense that the company have to bear since they have to buy stocks from suppliers. So after that, you deduct purchase return or return outward. Okay, so why do you say return outward? Because this is us returning stock to the supplier. So it goes out. That's why it returns outward. Okay, so please try to remember this, because remember its position, because this is important, so you won't gain a different total. Okay, so let us look back to the slide. So let us look at the example. So Jan 17 bought goods worth 400 from Aladdin by check. So just previously, as I stated, check. Check means money in bank. So what do we deduct? Deduct bank, since the money is in the bank. Okay. So what is the effect? The effect is asset is reduced since we have to pay, and expense increase since you buy goods. Okay, so you have to bear the expense. So what are the double entry? So when asset is reduced, it is on the credit side. So what is reduced? Bank. So your money in the bank is reduced. So what is on the debit side? Expense. See, ADE, it increase on the debit side using purchase account. Okay, so what is the amount? 400. Okay, so these are the journal entries. Let's open up a ledger. Okay, so what is the ledger? We have two ledger, which is the purchase and the bank. Okay, so the purchased, let us look previously. Do we have a purchase account open yet? This is cash and drawing, cash income, bank. Okay, so it seems the purchase account has never been opened. So the first transaction is 17 Jan, being purchased on the debit side. 17 Jan, bank 400. As you know, this is not the first transaction for the bank account. We have 3 different transactions before this, which being one Jan, buying a computer of 2.5k, 2,500. And on the credit side, we have 4th of Jan, capital of 10k, and 6th Jan, paying the rent expense of 500. And now again on the credit side, 17/1, due to purchase amount of 400. Okay, so these are the account. Okay, let's go to next. You guys can read into detail about inventory in chapter 44, in page 44 of your book, so you could understand more. Okay, so next we're going to go into discount. So discount is also for inventory. Okay, so for discount there are two types. The first one is trade discount, and the second one is cash discount. So trade discount is more simple. It is so to encourage buyer to buy in bulks, okay, large quantities, and the deduct is directly from the total selling price and will not be recorded in the book of account. Okay, so for cash discount, it is given so that the customer will make prompt payment. Prompt or fast. So tujuan cash discount diberi oleh seller kepada buyer ialah supaya buyer tu bayar hutang dia dengan lebih cepat. Okay. Okay, there are two types of cash discount. The first being cash receipt, which is the seller giving to buyer. So we receive, okay, we receive the discount. Seller give buyers the discount. Okay. So while for discount allowed, so discount allowed is as the seller give the customer a discount. So as also a seller to customer. Okay, so this is us, the business. So the difference being this allowed and receive is that the buyer is us. Okay, that's the difference. The first one we receive, the second we allowed. Okay, this the seller is supplier. Understand? Okay, so next slide. Okay, so just as explained before, this is trade discount, a deduction in price given to a trade customer when calculating the price to be charged to that customer for some goods. Okay. Okay, it does not appear in the accounting book. It does not appear in the financial statement. It is a track for bulk buying. Many. Okay. Trade discount ni diberi kepada customer untuk menggalakkan orang lebih banyak. Okay, secara borong lah. So, yang ini kamu tak payah risau. Just kamu risau pasal calculation dia sahaja. Sebab dia tak akan ada dalam financial statement dan kamu juga tak akan record dalam accounting lah. So, kita tengok calculation ni macam mana pula Okay, so example, Aminah bought goods in bulk. Many. From Ahmad Berhad worth 4,000 and payment is made by check. She was given a 5% trade discount. Okay, so this is what we're looking at. 5% trade discount So since the discount is not recorded in anything, in any financial or any book, so we just direct calculate it. See? So you just take the 5%, multiply it with the 4,000, you will get a deduction of 200. Okay, so this is the deduction. Thus, you will only have to pay 3,800. Only this amount is recorded. See? Paid by check, right? So, when you paid by check, the bank account increased. And you will also increase in your sales. Okay? Understand? So let's move on to the next slide. So in this slide, we focus on cash discount. Just as I explained before, it is an allowed given by seller to buyer. So this is allowance given to seller to buyer to encourage make prompt payment or fast payment. There are two types of discount. First is allowed, discount given to buyer, deduction from sales. So this is important, deduction from sales. So discount received is given by seller, deduction in purchase. Okay. They're not a deduction from selling price. Okay, not a deduction in selling. Both are recorded in the statement of profit and loss. Okay, they are recorded in the profit and loss. So let us look at the statement. See, you can see this discount allowed. So allowed, as I stated before, is us as the business give to the customer. So we record here since it reduced our sales income. So this is discount received because we receive the deduction from the seller, which is our supplier. Thus it reduce our purchase expense. So that's why we deduct here. Okay, remember its position, so you would be able to make this statement in the future. Okay, let's look at the slide again. Okay, so this time we will look at the example for discount allowed. You can turn into page 51 until 52. So in those pages, we'll focus on discount allowed. So the transaction are Jan 31st, Abdul settled amount owned by check after being allowed a cash discount. Okay, so Abdul was given a cash discount of 2%. So the cash discount is 2%. If you look at your book in page 52, you can see that the amount owned by Abdul is 2,850. You multiply that amount and you will gain a 57 discount. So that discount is recorded. As I stated, discount allowed is us as a business allowing customer to have discount. Okay, so they are customer that owe money to us. So where they owe money, we record in the account receivable, right? Since we'll be receiving the money in the future. So if they are given a discount, you have to deduct that account receivable. So it will put on the credit side, the asset will reduce, and the discount allowed will be on the debit side, since it is an expense to us. Okay, so this is the transaction for the discount RM557. So after that, you have to record the balance amount, which is the 2,850 minusing 57. You have to record the amount that Abdul have to pay. So Abdul said he has made the payment by check. So you debit check, which is a bank, and crediting the account receivable since Abdul has made the payment, amounting RM 2,793. Okay, so you have to look at the book while listening to this explanation. If not, you won't be able to understand. Or if you don't have the book, just zoom in the slide picture. It has the details here. Okay, so opening up the account that was made, we have three accounts. The first being account receivable. You record discount allowed on the credit side 57, and record bank also on the credit side 2,793, and the sales is recorded on the debit side, amounting to 2,850. So if you wonder where this Gen 19 transaction is, this is the first transaction lah, the sales transaction. It has to have a sales transaction before a discount is allowed. If there is no sales transaction, how could a discount is allowed? Because the customer has to buy something from us to have the discount. Okay. So next account is this discount allowed that have a debit of account receivable of 57. The next ledger account is bank, which has account receivable on the debit side amounting to 2,793. Okay, so next slide. So the next one is account discount received, which is us receiving the discount from the seller, which is the supplier. Us receive discount. Okay, so this discount reduce our expenses. So focusing on page 50 and 51, you can see that the paid amount owed to Aminah Trading by check after deducting a cash discount of 2. So this we also gain a 2% discount here. So the amount owed to Aminah was 1,900. So after multiplying with the 2% cash discount, we receive a 38 cash discount. So you have to record the 38 cash discount by deducting our account payable, since we owe to Aminah Trading. When the liability is deduct, it has to put on the debit side. Okay, so on the credit side, you will put the account receive, because it is an income to us, because we have to pay less. So you record 38 RM38 amount. So the next transaction is recording our payment. So you take the 1900 deduct 38, you will gain 1862. So we are making payment with check. So our check is reduced. So when our check is reduced, you credit bank. Okay, you credit the bank, and also reducing our liability, which is debiting account payable. See, with the amount after deducting the discount, which is 1862. So how many ledgers have been present in this transaction? 3 accounts is presented. The first being account payable for Amina Trading. We record under 31 Jan discount received of 38 and the deduct of bank for 1862. Whereas for the credit side, we record purchase of 1900. This is the earlier transaction, the purchase that we made. Okay, so you can see that both are balanced. That is what accounting is. Both sides needs to be balanced. Okay, the next account that is open is discount received, which you record Amina Trading on the credit side with the amount 38. While for the bank account, you record Amina Trading on the credit side with the amount 1862. Since it's a deduction in our bank. Okay, focus on page 51 and 50. 51 and 50. Okay, understand? Okay, going into the next slide. We will be focusing on carriage inward and carriage outward. What is carriage? There are transportation costs. So these are both expense to the business. There are traveling expense to the business. So however, carriage inward, postage or delivery cost expense from supplier to business will be recorded in the financial statement of profit loss as a part of cost of goods purchased, while carriage outward is recorded in SOPL as a part of operational expense. So what are the difference of these expenses? So carriage inward is supplier to us, business. That's why N. The supplier is sending in stock to us. Okay. While carriage outward is us, the business, sending to customer. That's why it's out. You will bringing out the stock. Okay. So both of them are expenses. So they are put on the debit side, since expense increase on the debit side. So it is reduced by cash or bank account. Okay, which are put on the credit side. So that's all. So let's look at the statement of profit or loss. Let us look. So you can see here, carriage inward is included in the cost of purchase, of cost of sales. So here it is. It is an expense that increase the purchase price, the purchase transaction, cost of purchase. So that's why we add it here. Okay. So while the carriage outward, which are here, it is a cost that we bear to give to the customer. So it is not related to the inventory cost. Okay, faham tak? So carriage inward ini adalah kos yang kita kena tanggung untuk bawa masuk stok. Okay, sebab tu kita kena letak dekat harga stok yang kita beli. Sebab dia included dengan harga barang, harga transport sekali semua tu, baru kita boleh tahu barang tu berapa ringgit, barang stok tu. So, untuk carriage outward pula adalah bila kita tanggung kos untuk hantar barang itu kepada customer. Okay, sebab tu di bawah operational expense. Sebab kita hantar bukan barang kita beli, barang yang kita jual. Okay, so that's in the statement of profit or loss. So that are among the cost of the inventory. So inventory have many costs in him. So please try to remember. So next slide. Okay, so next slide, in this slide, we'll be focusing on balancing of ledger account. So this is another subtopic, balancing of ledger account. So we'll be going into trying to balance the ledger account that was made. Okay, the purpose is to determine how much balance left in each account of end of the month. Okay, so you have the purpose of making the trial balance is to know how much balance of the account is left. Okay, that is the reason. So there are three types of balance. The first being debit balance, which is the debit is bigger than the total credit. The second one being credit balance, which is the credit is bigger than the total debit. Last one is zero balance, being that both of the balance of the right and left, debit and credit, are the same. Okay. Okay, so normally this balance, for debit balance, the asset, drawing and expense will end up with a debit balance in their ledger, while for the credit balance, the capital, liability and revenue will end up in the credit balance. So this is the normal balance that usually happens. Okay, but sometimes there would be abnormal, but that's rarely happens. Okay, so what is balancing of? So balancing of account and trial balance is at the end of the period, usually a month, the account are balanced. That is, the debit and credit entry are total and the difference is then entered as the balancing figure, or simply called imaginatively, of course, the balance. The balance of all the accounts are listed in a statement called the trial balance, which lists the account according to the balance. In other words, the debit balance is listed on the debit side, which is the left side, the credit balance is listed on the credit side, which is the right side. Okay, left and right. However, a ledger account that will have zero balance are excluded from the trial balance. Okay, so let's look an example. Okay, so this for this slide we'll be focusing on the trial balance. So you have seen the trial balance in the example, so let's go through it theoretically. So a trial balance is a list of ledgers account with a balance of a particular date. Okay, a trial balance is an important document in that it checks the accuracy of the entries in the recording process, although this list does not detect all the inaccuracy and errors. So sometimes errors happen. So rules is that total debit balance equals to credit balance. The trial balance serves as a basis of preparing the financial statement, which is the accounting target. Okay, the reason we're doing accounting is to prepare a financial statement. Okay, go next. So next in this slide, a trial balance is a list of account balance in the ledger T account according to the debit and credit balance. If double entry principle is applied correctly, a total balance should be equal to a total debit balance should be equal to the credit balance. This is what we're trying to achieve. Balance, we're trying to achieve this. The purpose of trial balance is to prove and check whether the debit equals to credit balance or not, to identify or uncover any errors in journalizing and posting. Say if the debit or credit balance is not the same amount or not balanced, error. It can detect error in the journalization and posting. Okay, that's how we detect any error or inaccuracy to assist preparation of the financial statement. Okay, so let's go through. So the format of the trial balance I've showed you before. So these are the formats. See, you can see the format. The other is in the debit. See, debit. While the color CLR is on the credit. Okay. So you can refer to my example before. See, so this is the format for the trial balance. You can also refer in your book. There's a format in there. So see, this is another format for trial balance that we won't be using this style. Okay, so this will be the format for the trial balance. And if you want to know how if the trial balance is correct or not, this debit and credit will be equal. But equal doesn't mean correct. Okay, sometimes even if you are balanced, the amount is sometimes recorded wrong. Okay, balance does not mean correct. Okay, there are some cases that trial balance are balanced but they are recorded wrongly. Okay, so double check your work. No, okay. So these are errors in trial balance. So error affecting trial balance not balanced, which means the debit side and the credit side are not equal due to some of it are single entries, you record only one transaction, errors of transposition, figures that are recorded in wrong order, errors in addition when the total up is wrong, posting to an incorrect side of the account, which means an account is supposed to be on the debit side, you record on the credit side, error in the trial balance itself. Okay, this could also happen in the trial balance itself. So that's how you have to check. Okay, so next is the error not affecting trial balance. The balance is correct. The balance is equal. Debits equals to credit. So the first error is error of omission. So when there was no recording either on the debit or the credit side. So the first is error of omission, which is neither of the transaction on the debit or credit side is put in the trial balance. Okay. Second is error of commission. So it is when the correct amount is posted into the wrong account of the same category of account. An error of principal is when an amount is posted into an account of different category. And the next one is complete reversal of entry, when the amount and the account are correct, but each item is shown in the wrong side of the account, which means you record it in its abnormal place. The debit is put on the credit side, while the credit side is put on the debit side. Lastly is the error of original entry, which is where errors are made in the book originally, which means in the journal entry. There's also another one in your book, compensating error. So it is error on the debit side is compensated by an error of an equal amount on the credit side. So both sides have error, but the error is made with the same amount. Okay, try to read this theory and understand it. So it starts off from page 62. Okay, try reading it in your book. So there's also explanation in this slide which I have stated before. You can look. Okay. Okay. So these are all explanation that I have explained before. So this will be the last slide for our chapter 4. So in this last slide, I like to remind you of the new terms that you just have encountered in this chapter. Since this chapter is quite long, you might have forgotten what you learned. So the first is account receivable, which is an asset used when a customer paid in credit. Business will receive money will receive in the future. Okay. While account payable is a liability, when we, the business, paid in credit. Paid in the future. Okay. So both the account payable and the account receivable are current. Less than 1 year. Okay. So the third term is return inward. In. So the stock going in to us. Customer return to business. Return outward. Business returns to supplier. Discount allowed. We, the business, allowed the discount. Okay. So it is deduct it deducts sales. So discount receive. Business receive. So it is a deduct in purchase because we pay less. So what is carried inward? Meaning it is delivery supplier to business. Okay. Outward business to customer. All of these are terms for inventory. Okay. So that is all. Hope you understand. Thank you.